Welcome to the Explainer. Okay, today we are going to objectively break down a century-old, entirely legal wealth preservation strategy that's utilized at the very highest levels of finance. It's a system literally designed to build and maintain dynastic wealth, and we're going to explore exactly how it functions, step by step, using the data and mechanics provided in our source material. So let's just dive right into this. We're starting with a paradox that you've probably heard dominating economic and political debates. How is it mathematically possible for individuals with just immense net worth to legally pay lower effective tax rates than everyday working professionals like teachers? Well, to really understand it, we have to look completely past all the political rhetoric and focus purely on the structural mechanics of the U.S. tax code. It's actually kind of wild to look at the timeline of how this knowledge became public. Way back in the 1990s, USC Professor Edward McAffrey coins the phrase buy, borrow, die, simply to help his students wrap their heads around these complex tax principles. And for a long time, it was sort of dismissed by some as just a simplified academic theory. But jump to 2021, and a major ProPublica investigation using leaked IRS data empirically verified it. They proved that this exact framework is actively used to shield vast fortunes from taxation. All right, here's our roadmap for today. 1. Two wealth paths. 2. Phase 1, buy. 3, Phase 2, borrow. 4, Phase 3, die. 5, Maria's math. And 6, the market impact. Section 1, Two wealth paths. How the working class and ultra-wealthy differ. So, if you're like most people, your wealth path is highly taxed and it's very linear. You earn a salary, you pay immediate income and payroll taxes, and then you try to save whatever's left over. But the ultra-wealthy, they completely flip this script. As our sources detail, they focus on buying assets that grow tax-free, and then strategically borrowing against those assets for cash. Their wealth rarely registers as traditional taxable income in the first place. Section 2, Phase 1, buy, the foundation of tax-free growth. The goal in this initial phase is to acquire highly specific types of assets. We're talking about growth stocks that don't pay regular dividends, real estate, fine art, private company shares. Basically, you want things you can just lock in a vault or let sit in an account so they appreciate quietly in the background. What you absolutely do not want is anything that throws off taxable cash flow, like regular dividends or rental income, because that would immediately trigger a tax bill. Because here is the golden rule, the absolute crucial point of the tax code. Unrealized capital gains remain completely untouched by the IRS. So as long as the asset is never sold, the wealth simply compounds uninterrupted. The individual's net worth just climbs higher and higher, all entirely outside the reach of taxation. Section 3, Phase 2, borrow, accessing cash without selling. But obviously, you cannot buy groceries or fund a lavish lifestyle with unrealized stock certificates, right? So to access liquidity without triggering a massive capital gains tax from selling, individuals utilize what's called a securities-based line of credit. Modern financial institutions have basically engineered these specific lending products so wealthy individuals can use their appreciating assets as collateral to secure massive loans, all while keeping their portfolio fully intact and growing. It all hinges on one profound reality. The government does not tax borrowed money. Whether you borrow $50,000 or $50 million against your portfolio, those loan proceeds flow directly into your bank account entirely tax-free. They can then be used for literally anything. Luxury purchases, funding your lifestyle, or even, buying more investments. And on top of that, the terms of these loans are drastically different from traditional borrowing. Because banks view these asset-backed loans as incredibly low risk, lenders might advance 70 to 80% of the value of the portfolio. Wealthy individuals can often negotiate interest rates way below what everyday borrowers pay, sometimes as low as 2 to 3% annually. Think about that for a second compared to the interest rate on your standard credit card or auto loan. Because the collateral is so valuable, the debt becomes incredibly cheap. Section 4, Phase 3, die. The ultimate intergenerational wealth transfer. Now, you might be wondering, eventually, don't all loans have to be repaid? Well, under current federal tax law, there is a fascinating provision called the stepped-up basis. When a person passes away, their heirs inherit their assets not at the original purchase price, but at the current market value on the day of death. This means decades of compounded appreciation simply vanish for tax purposes. The heirs can instantly sell just enough of these newly stepped-up assets to pay off the accumulated loan debt completely tax-free. Section 5, Maria's math, the strategy in action. To really grasp how this works, let's look at the actual math. Meet our hypothetical entrepreneur, Maria. Maria invests $1 million into diversified growth assets. After 10 years of a pretty conservative 7% growth rate, her portfolio has doubled to $2 million. Now, she wants to access some of this new wealth to fund her lifestyle, but she is faced with a choice on exactly how to do it. Look at the absolute divergence in these two paths. If Maria takes the traditional route and just sells her gains, she faces roughly $250,000 in combined state and federal taxes. That wipes out a quarter of her newly generated wealth. But if she uses the buy, borrow, die strategy, she borrows $1.4 million against her assets at, let's say, a 6.5% interest rate. That costs her $91,000 a year in interest. However, if her underlying portfolio is historically growing at 8%, making her $160,000 a year, she actually nets an annual profit of $69,000, all while legally sidestepping that $250,000 tax hit. It's a real game changer. Now watch how this compounds over a lifetime. Fast forward 30 years. Maria's portfolio compounds to $8 million. She has lived lavishly off of ever-expanding, tax-free loans. And the cycle just continues indefinitely because her asset growth consistently outpaces the accumulation of her loan interest. And this results in a rather staggering mathematical conclusion: $0. When Maria passes away, her heirs inherit that $8 million portfolio via that stepped-up basis we discussed earlier. They sell off $4 million to clear the outstanding bank loans. The result? They pay exactly $0 in capital gains taxes on 30 years of massive wealth accumulation, keeping the remaining $4 million completely tax-free. Section 6. The market impact. How this changes the overall economy. Moving past individual examples like Maria, we really need to zoom out, because as this strategy has grown, financial institutions have massively expanded the industry. It's no longer just traditional stocks and bonds acting as collateral. The wealthy can now borrow against private equity, hedge funds, real estate trusts, and yes, even fine art. The financial industry has effectively created a lending product for virtually every appreciating asset class. And the scale of this is immense. Standard entry requires at least $1 million in investable assets, with premium tiers starting at $5 to $10 million. But the absolutely critical insight here is how the math heavily favors scale. Basically, the richer you are, the cheaper your debt becomes. A $50 million portfolio might pay a full 2 percentage points less in interest than a $5 million portfolio, which structurally accelerates the creation of dynastic wealth across generations. This brings us to perhaps the most profound economic insight of this entire explainer. When you understand that wealthy investors using this strategy literally never plan to sell their assets, it changes market dynamics entirely. By permanently hoarding these assets to avoid triggering taxable events, a massive portion of market supply is just locked away. This creates artificial scarcity, which inadvertently drives up the cost of investments and inflates asset prices for everyone else participating in the market. Which leaves us with this final paradigm-shifting question. Politicians constantly debate raising or lowering capital gains and income tax rates. But if the most significant asset holders in our economy never actually sell their assets to trigger a taxable event in the first place, do those conventional tax policies even matter anymore? It really forces us to wonder if the standard debates are entirely missing the actual mechanics of modern wealth.